The current economic headlines suggest a system in crisis. U.S. inflation recently climbed to an annual pace of 4.2%, marking the highest reading since April 2023. This spike limits the Federal Reserve's options. With prices accelerating, the central bank appears increasingly likely to implement interest rate hikes before the end of the year. Geopolitical instability is compounding the domestic pressure. The downing of an American helicopter over the Strait of Hormuz has placed the U.S. on a path toward potential military retaliation against the Iranian regime. These combined pressures triggered an immediate flight from risk on Wall Street, leading to a rapid sell-off in high-growth tech stocks as investors braced for impact. A surface-level look at these events points toward an inevitable economic spiral. However, a closer look at the specific market data reveals a different narrative unfolding beneath the panic. To understand the actual health of the economy, we have to look past the top-line headlines and isolate the individual variables driving the index. The data suggests the market is following a highly orchestrated and far more stable path than the news cycle implies. The recent tech sell-off sparked immediate concern that the artificial intelligence boom was a bubble finally beginning to burst. Corporate behavior contradicts that fear. Industry leaders continue to commit massive capital to AI infrastructure, signaling a long-term belief in the sector's growth potential. This chart clarifies the situation. While stock valuations are pulling back from recent highs, the fundamental capital expenditures that drive the industry are steadily rising. The tech sector is essentially shaking off valuation bloat, even as it accelerates its investment into the next generation of computing hardware. To evaluate that 4.2% inflation headline figure, we have to determine if a 4% rate is actually a historical outlier. Historical data shows that a 4% inflation rate represents a standard baseline for the American economy. Over the last century, this specific rate occurred roughly 25% of the time. Our current expectations are shaped by the period following 1992. For 30 years, inflation remained freakishly low, staying mostly under 2% and creating a false sense of what a normal economy looks like. By century-long standards, we are simply watching the economy revert to its long-term mathematical mean. We still have to account for the military escalation in the Middle East, which has historically been a primary driver of global market shocks. This creates a pricing paradox. In a typical conflict, oil prices would likely surge toward $150 a barrel, yet prices have stayed near $91, a sign that the market is absorbing the geopolitical tension without panicking. That price ceiling is maintained by Project Freedom, a covert logistics effort designed to prevent a massive global supply shock. Tanker crews are increasingly disabling their transponders and navigating dark to ensure oil continues to reach Asian customers, despite the regional threats. Because traders know this oil is still reaching the market, the anticipated price shock has been completely neutralized. This controlled energy market explains why the 4.2% inflation headline is such a poor indicator of the broader economy. The divergence is clear when we look at this data. While energy costs pushed the top-line figure higher, the prices for actual core goods fell by 0.11% in the most recent month. This proves that consumer supply chains are functioning normally. The inflationary pressure is entirely isolated to the specific energy bottleneck in the Strait of Hormuz. Once that geopolitical bottleneck is cleared, those specific energy pressures will dissipate, likely causing the headline inflation number to drop as it aligns with the falling prices of core goods. The takeaway is to avoid trading on geopolitical headlines. The current economic spike is entirely transitory and isolated, and the underlying system is operating exactly as it should.